They say better late than never, and China Evergrande Group took that literally as they managed to avoid default on one of its US dollar bond payments last week. I would say that things are starting to look brighter, except for the other developers missing payments as well, and Chinese real estate and bond markets falling. In today's video, we're going to look at the latest events taking place in China's real estate market and look further into how that might impact U.S. real estate, looking specifically at the major markets in Southern California. Let's get into it. Last Friday, the property developer China Evergrande Group was reported as making an $83.5 million interest payment on their March 2022 offshore bond, allowing them to avoid an official default on that specific liability. This was unexpected by many analysts who had assumed they were just going to focus on their domestic commitments within China. And, after all, the Chinese central bank assured us that the risks posed by Evergrande are controllable. I would say things are starting to look better, but given that this is coming from the same people whose efforts to control the flow of information has been likened to a modern marvel of the world, let's say I'm a bit skeptical of their assurances. Plus, you would have to ignore what's happening in the rest of the Chinese real estate industry. Like what's happening with this developer, Fantasia Holdings Group, who actually did default on a US denominated bond, and this developer that also defaulted, and this developer, and this developer. And home sales are falling, and junk bond yields are soaring, and their economy is slowing in growth rates. Okay, I'll stop right there. You get the idea. We're clearly not out of the woods yet. But let's give credit where credit is due. They made payment on a liability most people assumed they would write off. And after the Chinese government encouraged them to do so. This is a good thing. We don't want the Chinese real estate industry to collapse. However, with Chinese home sales falling and bond yields soaring, it's going to be pretty hard for these companies loaded with debt to roll it over when it comes due. Absent a bailout of some form, it's hard to see how this train isn't going to go off the tracks. But the Chinese government has not given any indication that a bailout is coming. Perhaps, and I'm speculating here, the fact that Evergrande made the payment could reflect the Chinese government realizing how bad this could actually get. We also don't know what kind of things could be happening in diplomatic channels behind the scenes. Honestly, I would hope that the U.S. government's current administration would be concerned of another major nation's property sector ignoring significant liabilities denominated in U.S. currency. We won't go too far down that rabbit hole in today's video. Evergrande has more dollar-denominated debt payments to make in November and December, so those will be key to watch to see if their situation is actually improving or there's continuing willingness to make good the company's US dollar-denominated liabilities. Maybe I'm being a bit too cautious, but I'm going to watch what they do and not trust what they say. Now to the big question, and probably why most of you are watching this video. If things go bad, how is it going to hit us here in the U.S. real estate market? In our first video on this topic, we identified the exposure U.S. real estate had to Chinese ownership to help us focus our research efforts. So make sure you check that video out if you haven't already. I'll leave a link to it in the description down below. We found that California markets had the biggest exposure, and earlier this month we took a look at the major Northern California markets in the San Francisco Bay Area. Today we're looking at Southern California markets. If you like what you're seeing so far, please give this video a thumbs up. It really helps our channel grow by boosting this video in the YouTube algorithm. And if you haven't already, I hope you will consider subscribing and hit that notification bell down below so you know right away when our next video on this and other topics comes out. All right, let's get into the data and see what Southern California markets have to show us today. We'll start with prices. Over the last 5 years, prices have trended steadily higher, with a big acceleration after the pandemic lockdowns in the first half of 2020. Recently, however, there has been a noticeable slowdown in activity over the last few months, with the median home price across all properties trending sideways in the Los Angeles, San Diego, and Riverside metropolitan areas. Southern California is not alone in this. In fact, it's a statewide trend. We see it here again in the median price for the state of California overall. And we see it here in the national price level as well, although not as much as in the California markets. That difference between the severity of the slowdown in California and the nation overall in the latest data is something we'll be looking more into carefully in future videos as the trend develops moving forward. California is home to many of the top 20 markets we're keeping an eye on for our series on when is the housing market going to crash. I'll leave a link to that playlist in the description down below, as well as a video where we covered how we came up with the list of the top 20 markets. For now, we'll stick with Southern California markets and see if we can figure out if the weakness is coming from the supply or the demand side of the local markets. Looking at the supply side of the market, we can see that the month supply, or the number of months that market inventory would be depleted at the current pace of sales, it's at historic lows and actually ticked lower in all three of our Southern California markets we're watching. New listings are flat to down in all three markets as well, although generally holding above pre-pandemic averages. So overall, supply is still pretty tight with those inventory levels at historic low points. I don't see anything here on the supply side that would suggest weakness in the market. Let's take a look at demand. Home sales ticked up in all three metros in September and are generally staying above pre-pandemic averages. Here's where we're seeing a clear trend change though. This is the average sales to list price ratio, and it's noticeably trending lower in all three metros. This is where the weakness is coming from, and affordability is the culprit yet again. A drop in this metric from previous levels suggests that the appetite for bidding homes over list price has run its course. The ratio is still above 100, but if it keeps falling, that will push down listing prices going forward once others spot this trend. So overall, demand is not plummeting, but we're hitting that upper bound on affordability, which is leading to softer price growth. We touched on this in our video last month on the topic, so check that one out if you want to go into more detail on that subject. Now, the big question. What does this mean for the U.S. housing market in the unfolding crisis for Evergrande and Chinese real estate? As I mentioned in our last video on the topic that focused on Bay Area markets, a collapse in asset prices and falling liquidity in China could lead Chinese owners of U.S. real estate to liquidate their holdings here to raise cash. And given that we're seeing a softening market already, any additional downward pressure on prices would likely have a much more significant impact than if our markets were stronger and able to absorb the shock. We'll be doing an update on the Bay Area markets with this new September data in an upcoming video soon. So make sure you're subscribed, hit that notification bell so you know right away when that video comes out. If you're watching this on our Real Estate Watch channel, don't forget to check out our main channel, PapayaCast, where we cover much more of the overall economy than we do here. Right now we're focusing a lot on our inflation outlook, which can have ramifications for the real estate market going forward as well. If you found this episode useful, please give it a thumbs up to support the channel. Thanks for stopping by, and I'll see you in the next video.